After studying this module, you shall be able to know the meaning of risk and uncertainty, learn how to diversify the risk, identify the sources of risk, evaluate the potential of an asset for an investor through capital asset pricing model. Microsoft Corporation first issued its stock to the public in 1986, and in the same year it became defunct. Investment environment is unpredictable and volatile. Investment may have different meaning depending on its uses. In finance, it means purchase of securities. However, in economics, investment means buying of real assets. In general, investment means employment of funds to earn profits. Features of investment. Return are the benefits of it. Variability in expected return is known as risk. T-bills are risk-free instruments as these involves fixed return and don't have default risk. Time horizon, tax benefit. Liquidity means transformation of investment into cash without much loss of its value. The primary objective of finance manager is to optimize the value of the firm. To achieve this objective, he has to affirm the balance between the risk and return while taking any kind of investment decision. He has to forecast the future return while taking the risk or jumping into a new project. Manager's decision is directly or indirectly connected to risk return factor. Thus, it becomes very crucial for a manager to analyze completely all factors which may affect the firm in future. Impact of inflation on investment. Inflation corrodes the purchasing power of money. Thus, the instrument may not be profitable as the purchasing power of the fixed assets will be less in future. Securities are shares, bonds, debentures, options, etc. Portfolio means combination of two or more financial assets. Risk means the probability that the actual performance oblique outcome from an investment may differ from the targeted performance oblique outcome. The more the range of possible outcome, the more will be the risk. They are in form of interest, dividends, yield, and income derived from the security in relation to its price. Appreciation, oblique depreciation of an asset price, etc. The primary objective of finance manager is to optimize the value of the firm. To achieve this objective, he has to affirm the balance between the risk and return while taking any kind of investment decision. He has to forecast the future return while taking the risk or jumping into a new project. Manager's decision is directly or indirectly connected to risk return factor. Thus, it becomes very crucial for a manager to analyze completely all factors which may affect the firm in future. Impact of inflation on investment. Inflation corrodes the purchasing power of money. Thus, the instrument may not be profitable as the purchasing power of the fixed assets will be less in future. Securities are shares, bonds, debentures, options, etc. Portfolio means combination of two or more financial assets. Risk is expressed by the variability in the likely outcomes. This variability is known as dispersion. High variability is associated with high risk and low variability is associated with low risk. If there is no variability in an asset, then an asset has no risk. Slide 9. The variance of an asset's rate of return can be calculated by the following equation, where N is equal to the number of states, Pi is the probability of state I, Ri is the return on the stock in state I, and E within bracket R is equal to the expected return on the stock. The variance of an asset's rate of return can be calculated by the following equation, where N is equal to the number of states, Pi is the probability of state I, Ri is the return on the stock in state I, and E within bracket R is equal to the expected return on the stock. Another way to calculate the variability of returns is standard deviation. The standard deviation is the square root of the variance of the rates of return, which is denoted by sigma. Sigma is equal to under root variance within bracket R. Every investor has an objective to maximize the expected return from his investment. Expected return is the only factor which attracts investors towards a particular project or a firm. But future is uncertain, and expecting return without considering risk factor is an imagination only. Thus, investor will focus the following factors while investing into any project. Measure the past return of all the alternative options available to the investors and evaluate how well they have performed. Estimate the future returns of all the alternatives by taking their past returns as the base. Compare all the alternatives according to their past and estimated future return and analyzing the risk level involved. There are two types of returns. Realized return, it is also known as ex post return or return which has already been achieved. Expected return, it is a return which an investor expects or anticipates earning in future period. It involves an uncertainty factor, that is, return may or may not occur. The rate of return is the cash flows or income from the securities and the difference in the price of the securities between the beginning and end of the holding period, expressed as a percentage of the purchase price of the security at the beginning of the holding period. Following is the formula to measure the rate of return. K is equal to within bracket dt plus within bracket pt minus pt minus 1 bracket closed bigger bracket closed divided by p t minus 1. K is equal to rate of return, dt is equal to income receivable from the security at time t, pt is equal to price of the security at time t, pt minus 1 is equal to price of the security at time t minus 1. Example, calculate the rate of return if a 15% rupees 1000 debenture was purchased for rupees 1500 and the price of the security increased to rupees 1800 by the end of the year. Solution, the rate of return is equal to 150 plus within bracket 1800 minus 1500. This whole thing is divided by 1500 and this gives a return of 30%. Example, calculate the rate of return if a share of ABC is purchased for rupees 4,500 on March 10 of last year and sold for rupees 4,900 on March 11 of this year, and the company paid a dividend of rupees 40 for the year. Solution: rate of return is equal to 40 plus within bracket 4,900 minus 4,500 divided by 4,500. This will give a return of 9.78%. Risk averse investor. Risk averse investors are those who avoid risk and want more than proportionate return for every extra unit of risk. Risk neutral investors. These investors do not consider risk and analyze risk solely by their expected rate of return. For them, risk proportion is irrelevant. Risk lovers. Investors assume risk irrespective of outcomes. Investors are generally gambler. Expected rate of return may or may not be materialized in an uncertain future. Thus, the expected rate of return is the weighted average rate of return by using the probability of each rate of return as their weight. The following equation represents the expected rate of return. Expected return is calculated by using the following formula. Written another way, the same formula is as follows. Expected return is equal to P1 into R1 plus P2 into R2 plus dash 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 plus Pn into Rn. ER is equal to expected rate of return. PI is equal to probability with ith possible outcome. Ri is the rate of return from ith possible outcome. Example, calculate the expected rate of return from the following probability distributions and corresponding rate of return for ABC company. The solution is 0.1 multiplied by 0.4 plus 0.1 into 0.3 plus 0.5 into 0.2 plus 0.2 multiplied by minus 0.2, 0.1 into minus 0.2. This simplifies to 0.04 plus 0.03 plus 0.1 minus 0.04 minus 0.02. This sums up to 0.11, which is equal to 11%. Risk is measured by the width of a probability distribution of rate of return. The wider the probability distribution, the more is the risk. Example, calculate the expected rate of return of ABC company and PQR company from their corresponding probability distribution of the rates of return which are given below. First, consider the ABC company. The expected rate of return is equal to 0.04 into 0.35 plus 0.21 into 0.20 plus 0.50 into 0.10 minus 0.18 into 0.08 minus 0.07 into 0.2. This is equal to 0.014 plus 0.042 plus 0.05 minus 0.0144 minus 0.014 This aggregates to 7.76%. Now for PQR company, expected rate of return is equal to 0 0.1 into 0.8 plus 0.23 into 0.4 plus 0.32 into 0.20 minus 0.25 into 0.08 minus 0.10 into 0.4. This is equal to 0.08 plus 0.092 plus 0.064 minus 0.02 minus 0.04. This simplifies to 17.6%. PQR company is more risky than ABC company because of its wider probability distribution. However, the expected rate of return of PQR company is higher than ABC company. Thus, for greater return, investor has to assume greater risk too. There are many factors that make the financial asset risky. Some of the factors are given below. Interest rate risk. Variability in securities return due to change in the level of interest rate reflects the interest rate risk. Bond holders are more directly affected than equity investors. Securities prices move in inverse direction to interest rates. Market risk. It is the change in the return due to the change in the securities market. Risk is like depression, wars, politics, etc. Inflation risk. It is also known as purchasing power risk, as increase in inflation reduces the purchasing power. Interest rates rise with inflation. Thus, there is a direct relation between inflation risk and the interest rate risk. Business risk. It refers to the risk involved in doing a business. Financial risk. Financial risk occurs due to financial leverage or the use of debt financing. The more the use of debt by the company, the more will be the financial risk. Liquidity risk. Security that can be sold out without any price concession is known as liquid. The more the uncertainty about the price concession and the time element, the more will be the liquidity risk. For example, treasury bills have low liquidity risk because they have ready markets. The most important thing for an investor is to decide the amount of risk he can bear. Risk return trade off is balance between the highest possible return and the lowest possible risk. There is generally a direct relation between the risk and return. High level of uncertainty or risk is linked with high level of returns, and low level of uncertainty or risk is linked with low level of potential returns. The following graph depicts the risk return trade-off. From the above graph, it is concluded that to enjoy high return, investors must also take high risk, and if he wants to avoid risk, then he has to be satisfied with the low level of potential returns. Diversification is an important process to minimize the risk. However, it does not guarantee against a loss. Risk can never become zero for how much diversification an investor is going for. Risk can be diversified or reduced by diversification due to the investment in diversified portfolio that may contain equity capital, bonds, real estate, collectibles, bullions, saving accounts, and other assets. Investment in single security is riskier than investment in a portfolio because the investor's return is based on the future of single security only. Return on portfolio may be more stable than return on single stock because the loss of one would be compensated by the profit of others. All stocks have some degree of correlation because of common economic, social, climate, and political factors. Perfectly negatively correlated stocks move in the opposite direction in the same manner, and perfectly positively correlated stocks move in the same direction in the same manner. In a two security portfolio, diversification may lead to low or zero risk if stocks in the portfolio are perfectly negative correlated. Thus, higher the degree of negative correlation, higher is the level of risk reduction. Another factor which should be considered while diversification is the number of stocks in the portfolio. As the number of stocks rise, the effect of risk reduction of diversification on each additional stock decreases. Apart from diversifiable risk, there is a non-diversifiable risk too that do not get affected by the portfolio size and remain constant with the time horizon. Non-diversifiable risk is basically related to the stock market or the general economy, which cannot be removed by diversification, like interest rate risk, inflation risk, financial risk, etc. However, diversifiable risk is a risk which is related to the company or industry. It is known as unsystematic risk or specific risk, which can be eliminated by diversification. There are many factors for non-diversifiable risk like major changes in tax rates, wars, calamities, changes in economic policy, market recession, changes in inflation rates, etc. Diversifiable risk factor can be death of key company officer, competition in the market, strikes, etc. There are many kinds of risk involved in investment decision, and it is essential to attain a balance between risk and return to achieve the financial goals. In a portfolio of two risky assets, the portfolio risk can be calculated as given below. Sigma portfolio is equal to under root of W1 square multiplied by sigma 1 square plus W2 square multiplied by sigma 2 square plus 2 W1 W2 P12 sigma 1 sigma 2, where W1 is equal to proportion of portfolio invested in asset 1, W2 is equal to proportion of the portfolio invested in asset 2, sigma 1 is equal to asset 1 standard deviation of returns, sigma 2 is equal to asset 2 standard deviation of returns, P12 is equal to correlation coefficient between the returns of asset 1 and asset 2. Portfolio risk is the risk of risky assets multiplied by the proportion of funds invested in it and degree of correlation between the two assets. Example: risky asset 1 has expected return of 10% and standard deviation of 18%. Another risk asset 2 has expected return of 6% and standard deviation of 14%. Coefficient of correlation between the two risk assets 1 and 2 is minus 0.86. Calculate the portfolio return if 50% is invested in each risky asset. Solution: portfolio return RP is equal to W1 into R1 plus W2 into R2. This is equal to 0.5 into 10 plus 0.5 into 6. This is equal to 8. Portfolio risk sigma portfolio is equal to W1 square sigma 1 square plus W2 square sigma 2 square plus 2W1 W2 P12 sigma 1 sigma 2. This simplifies to 0.5 square multiplied by 18 square plus 0.5 square multiplied by 14 plus 2 into 0.5 into 0.5 into minus 0.086 into 18 into 14. This simplifies to 10.916. If the securities in portfolio are negatively correlated, then holding these securities can reduce the portfolio risk. If the coefficient of correlation between securities is -1, that is perfectly negative correlation, then this can even eliminate the portfolio risk. You know, sigma p is equal to under root of W1 square multiplied by sigma 1 square plus W2 square multiplied by sigma 2 square minus 2W1 W2 sigma 1 sigma 2, because the correlation coefficient between these two securities is -1. This simplifies to under root W1 into sigma 1 minus W2 sigma 2 whole square, which further reduces to W1 sigma 1 minus W2 sigma 2. So for zero portfolio risk, we can keep this equation equal to 0. That means 0 is equal to W1 sigma 1 minus W2 sigma 2. And this will give W1 is equal to sigma 2 divided by sigma 1 plus sigma 2, since W1 plus W2 is equal to 1. The exposure to risk is 0 or nil. Such assets are known as perfect hedge. A perfectly hedged position can be obtained by the following position. W1 is equal to sigma 2 divided by sigma 1 plus sigma 2. To reduce the portfolio risk, we invest in two or more securities known as diversification. Lower the coefficient of correlation, the greater will be the benefit of diversification, hence lesser will be the portfolio risk. If securities are perfectly positively correlated, then there will be no risk reduction, but just risk averaging. The standard deviation for the portfolio will come down to W1 sigma 1 plus W2 sigma 2. Again, because coefficient of correlation between the two securities is 1. For minimum variance, W1 is equal to sigma 2 square minus R12 multiplied by sigma 1 sigma 2 divided by sigma 1 square plus sigma 2 square minus 2 sigma 1 sigma 2 R12. We get the above equation by substituting W2 with 1 minus W1 in the portfolio risk equation given above. Portfolio of one risky asset and one risk-free asset. For example, a portfolio has risky asset A having expected return of 10% and standard deviation of 20%. And there is a risk-free asset B having expected return of 7%. Portfolio comprising 50% of each asset. What should be the expected return and risk of the portfolio? Solution. Expected return RP is equal to W1 into R1 plus W2 into R2. This is equal to 0.5 into 10 plus 0.5 into 7 is equal to 8.5%. Portfolio risk sigma P is equal to under root of W1 square multiplied by sigma 1 square plus W2 square into sigma 2 square minus 2W1 W2 sigma 1 sigma 2. The standard deviation for second security and the coefficient of correlation between the two is 0. So this reduces to W1 sigma 1, and this simplifies to 0.5 into 20 is equal to 10%. It is a straight line originating from risk-free rate. It shows all the risk-return combinations available to the investors. Every point shows portfolio risk and return relationship. The slope of the line is reward to variability ratio. Slope is equal to within bracket expected return minus risk-free return divided by sigma p, or we can simplify within bracket expected return rp minus rf divided by sigma p. Most finance professionals use CAPM to calculate the return which the investment should bring. CAPM calculate the expected return based on the risk, and thus this model relies on the beta coefficient known as risk multiplier. Assumptions of CAPM. All investors are rational and risk averse. Investors may lend or borrow unlimited amount at zero risk rate. There is no restriction on short sales. All investors have same level of expectation. Financial assets are completely divisible and can be sold at market price at any time. There are no transaction costs, no taxes. Investors' activities do not influence market prices. Financial assets quantities are fixed. The CAPM formula to calculate the required return is R star is equal to RF plus beta multiplied by Km minus RF, where R star is equal to required return. RF is the risk-free rate, Km is the average market return, beta is equal to beta coefficient of the security. In the above graph, the blue straight line is known as security market line. Beta coefficient of security market as a whole is 1.0, and beta coefficient of individual companies are calculated relative to market's beta coefficient. If beta is greater than 1.0, then risk is higher than market average. If beta is less than 1, then risk is lesser than market average. Security market line. SML is the graphical representation of CAPM, or the expected return beta relationship. Beta is an appropriate measure of risk as it is proportional to the risk that the security contributes to the optimal risky portfolio, and that is systematic risk. Risk premium Km minus RF is the slope of security market line SML. If the expected return risk relationship holds for any individual asset, it must hold for any combination of asset. Thus, CAPM holds true for efficient portfolio as well. Uses of CAPM. Many industries find their stocks with positive alpha. Alpha is equal to actual return minus expected return as per CAPM. Alpha can be positive or negative or zero. All the stocks lying above SML are positive alpha and are desirable also. These stocks are underpriced. Stocks which are lying below SML are not desirable and are overpriced. CAPM gives the appropriate discount rate or cost of capital used in capital project evaluation. Example: stock A has expected return of 13% and beta is 1. Stock B has expected return of 11% and beta is 1.5%. Market expected return is 12% and risk-free rate is 5%. According to CAPM, which stock is a better buy and why? What is the alpha of each stock? Expected return as per CAPM of stock A is equal to ERA is equal to 5 plus 12 minus 5 into 1 is equal to 12. Alpha stock A is 13 minus 12 is equal to 1%. Expected return as per Capm stock B, ERB is equal to 5 plus 12 minus 5 into 1.5 is equal to 15.5. So alpha stock is equal to 11% minus 15.5%. This is equal to minus 4.5%. Alpha of stock A is positive and of B is negative. Thus, stock A is better to buy as it has positive alpha. The risk of the security is determined by the variability of its return. Standard deviation and variation of returns are the measures of riskiness of the security. Unsystematic risk is the risk which the firm can avoid or diversify. Thus, it is also known as diversifiable risk. Systematic risk is the risk which the firm cannot avoid as it refers to the factors which affect the whole market. It is also known as non-diversified risk. Modern portfolio theory has developed the concept of security market line. SML represents the trade-off between risk and return for a group of securities. Capm is used to examine the market efficiency. Value of alpha is used to evaluate whether the security is overpriced or underpriced. Okay.